Venture capital is the rocket fuel that's propelled the vast majority of generational tech companies from SpaceX to Google, Amazon, and Facebook. But it's also just very unclear to many founders whether they should or can raise venture capital. Hey everyone, I'm Wayne. I've been a venture capitalist in Silicon Valley for the past decade, and today I'm going to answer the number one most common question I get from founders, which is what kind of metrics do I need to successfully raise venture capital? So let's be clear up front, traction is not the only thing that matters. VCs also care a lot about the team, the market differentiation, and so forth, but there are nonetheless some very clear patterns in companies that do get funded. And I have the data to prove it. I'm actually going to share with you some real traction metrics from a large data set of companies that have successfully raised venture capital. So let's get into it. Before we dig into the question of how much traction you need, it's important to step back and understand the mindset of a venture capitalist on metrics. If you're raising the classic Series A from Silicon Valley firms, the Sequoias, Kleiners, and Benchmarks of the world, the thing that VCs are conceptually going to try to find in your business metrics is replicability. Have you built an engine at the level of understanding that you can put $1 in and get $2 out the other side? That's when your business is ready for a huge capital infusion, and VCs want to be the ones funding that inflection point. Now, what that actually means in terms of specific numbers is dependent on your business. Every company really is a special snowflake, and so VCs naturally look for different metrics to judge every company by. But that said, there's certainly a couple major archetypes that cover most companies, namely consumer B2C businesses and enterprise B2B software SaaS businesses. So I'll focus on those in this video. With that out of the way, the first piece of traction that VCs are going to look for is momentum in your business, top-line revenue scale and growth. This is the classic up and to the right graph. But that actually depends a lot on what stage of company lifecycle you're in. It's much harder to triple your revenue when you're a $100 million revenue business than if you're at $100,000. So with that in mind, let's look at the actual growth and revenue data from a sample of hundreds of anonymized companies that successfully raised from a top-tier Silicon Valley VC. Let's start with SaaS companies, the classic software as a service businesses. What you're looking at here is the top quartile, median, and bottom growth rates of various companies as they scale revenue. This bottom one, you can kind of think of as the bottom growth rate you need to stay on the venture fundable track. And just to clarify here, when I say revenue run rate, I'm referring to last month's revenue multiplied by 12 to annualize it, which is the most common method of calculating your run rate. The Series A, at least at the time of this video, is typically a $10 to $20 million round where companies are roughly around the $1 million run rate range. The average VC-backed startup doing that kind of revenue more than quadrupled year over year. So it had grown from, say, 200 to 250K to $1 million in run rate in that year. Now, 5 million run rate is a common milestone for raising a Series B or a growth type round. And you'll see the average business at that stage roughly tripled year over year. The top quartile of venture-backed startups are actually still quadrupling year over year at that stage. On the other hand, the minimum growth rate at that scale for companies that raise venture is at least doubling year over year. So say from 2.5 to 5 million in run rate. And of course, if you want to have a strong chance of raising venture, much less a competitive fundraise, you ideally want to do more than just clear the bar, so to speak. Once SaaS businesses get to 10 or 20 million in run rate, they tend to take a nosedive in terms of growth and converge roughly around doubling year over year. And growth rates continue to slowly decay at that point, all the way to IPO or exit. Because this data is looking at averages, it definitely misses some outliers that do some insane growth. Hopin, for example, is famous for recently going from 0 to 100 million in run rate revenue in just 2 years. But this will give you the rough pathway that the majority of VC-backed startups take en route to an IPO. Okay, now let's extend this to a consumer business, which is graded on a completely different curve. A consumer's pocketbook for a monthly subscription is much more fickle than enterprise budgets. A decent consumer transactional business might have, say, 30 to 40% of their customers sticking around after a year, whereas a good enterprise company will actually have more than 100% revenue retention because customers often increase spend year over year. And consumer products also tend to be lower margin. A good range would be, say, 50 to 70%, while a SaaS business could be close to pure profit, say like 90%. So if you multiply that all the way through, that might suggest that $1 of enterprise revenue is worth more than 5 times a consumer dollar. That's just 1 year though. So this skews even more enterprise heavy if you extend the time horizon to say 2 or 3 years. That said, consumer businesses sometimes grow more quickly as well. So let's just maybe cancel that out for the sake of simplicity. So net-net, if you're a consumer business, that might suggest that you should take the numbers on the curves I showed you and maybe multiply them by 5x. As of this video, the average public market SaaS multiple is about 16 times revenue, while the average e-commerce multiple is, say, between 3 to 5. Stitch Fix is trading at roughly 3x revenue. So that's a roughly 5 times lower multiple than SaaS. So if you're raising a Series A as a $1 million run rate SaaS business, That might suggest the equivalent scale for a Series A consumer business would be, say, 5 million in run rate, and it would be a higher growth rate to reach those scales as well. Now, these curves are not the end-all be-all. For example, there may be companies in niche markets that actually fit these curves, but investors wouldn't touch it because they'd think there's little chance it could be a big outcome that could return 10 or 100x their investment. And maybe there are companies with slower growth that are still exciting for VCs, say like a quantum computing or life sciences company, where if they got it right, no one questions the market size. And so investors are willing to ignore lack of traction in search of the big payoff. But I can tell you, the data would suggest if you're, say, $1 million SaaS company growing, say, 50% year over year, it's probably unlikely most VCs would fund that business. You know, I wondered why VCs haven't shared this kind of data yet, and maybe it's because they don't want to discourage founders, but I'm hoping that being more transparent to founders on what kind of traction VCs are generally expecting is going to be a net benefit. Now, besides that revenue and growth, VCs also care about your efficiency. Doesn't matter if you're growing tons, if you're burning wads of cash to do it. As a quick thought experiment, you and I could start a hypothetical business that hands people $2 in exchange for $1. And we could book each dollar as revenue, mind you at negative 100% margin, but grow like a weed. Now that's obviously not sustainable, so VCs also care about whether the core unit economics of your business makes sense. The lens that most VCs use to evaluate efficiency is LTV to CAC ratio and paybacks. LTV is the lifetime value of a customer, how much they're worth to you in profit, not revenue, and factoring in churn. CAC is the cost to acquire and convert that customer into a paying user. Generally speaking, VCs are expecting companies to have a 3 or 4 to 1 LTV to CAC ratio. That's a sign that you have an engine to acquire customers and make money from them in a high leverage way. The most efficient e-commerce business that I've personally seen is Stitch Fix, which incredibly added $10 in revenue for every dollar of venture capital they raised. Huge props to Katrina Lake, by the way. Now, VCs also look at how quickly you can pay back the cost of customer acquisition with margin from that customer. The reason why that's important is because time is money for startups. So the faster that you can recoup the cash that you sunk into acquiring a customer, the faster you can redeploy that money to continue growing. On the B2C consumer side, you're generally looking for 3 to 6 month paybacks, with less than 3 months being best in class. These payback periods for consumer businesses generally get worse over time, and it's not uncommon for paybacks to double every time the business grows an order of magnitude. On the B2B SaaS side, remember how we said you can think of the quality of SaaS revenue being much better? Well, it so happens if you multiply a 3-month payback by 5 times, you get a 15-month payback, which is somewhat middle of the road for a SaaS company. Anything over 18-month paybacks are generally pretty tough for VCs, and they're ideally hoping for 12 months or even less. Now, this can change if your product happens to be unusual in retention or margin. There's certainly consumer products that could be stickier than your classic 30 to 40% retention products. In those cases, you can extend out your paybacks because you're going to get more money from consumers in the out years. That highlights a broader principle, which is that there's just some businesses that break the convention of unit economic benchmarks. That could be because the product spreads virally or is adopted bottoms up, or has major network effects, which means that there's declining or zero customer acquisition costs. VCs naturally love backing businesses that have caught that kind of lightning in a bottle. It's important to note there's definitely other metrics that matter too, like churn and retention, for example, but I'd argue it's still possible to build a great business with inherently high churn products and markets. If you're selling to SMBs, for example, where 20% of them just structurally go out of business every year, you can still build a great business like Shopify has if your LTV to CAC and your paybacks still make sense. Okay, but what if you're still in the idea and exploration phase, pre-product market fit, well before the Series A? Here's my 2 tips for you. Number 1, focus more on storytelling generally. Don't rely too heavily on your traction. Use it as a supporting actor in your overall narrative. If you're not drowning in customers yet, raising venture capital really is more about storytelling. The earlier you are in your journey, the less numbers there are. So the more that you have the latitude to shape the interpretation of what little numbers there are. Just make sure at this early stage, focusing too much on the numbers doesn't come at the expense of your overall story, your team, the size of the market, and your ability to articulate a vision of the future that you can unlock. That is going to mean more to most VCs rather than the fact that you grew 20% to say $10,000 in revenue, which is still too small to mean a lot. It doesn't mean that traction isn't important at all. And in fact, it becomes increasingly important if you're not a successful venture-backed founder or you haven't worked for one of the top tech companies. I really wish it wasn't the case, but VCs see thousands of deals per year. And so often the easiest way to prioritize is just the pedigree of the founder. So Chad Hurley, the creator of YouTube, can raise money pretty early in his company lifecycle at the idea stage because he's made VCs a lot of money before, and he's got a stunning track record of inventing technology that's literally transformed the lives of billions of people. For the rest of us, mere mortals, traction is perhaps a more likely way to convince VCs that you can execute quickly, even if you're not a product manager from Stripe or Facebook. Just remember that at small scale, it's hard for traction to actually mean a lot. So in many cases, VCs are actually using traction as a way to judge you and your execution more than anything else. Fit traction holistically into a picture of how you're executing quickly, alongside, say, creative experiments that you've run, unique insights that you've learned from the market, hiring moves you've made, advisors you've brought on board, partnerships you've made, and so on. So this leads me to point 2, which is showcase metrics that are leading indicators of traction for your business. That could be product usage, it could be sales lift your tool generates, it could be NPS, retention, whatever it is, show momentum in that as a sign of revenue to come. In that spirit, my last bonus tip for you is to take control of your own destiny in defining the metrics that a VC should judge your business by. I find founders sometimes over-rotate on VC feedback on what metrics to shoot for. But that might not be a great idea before your business is well defined, especially for more unusual businesses, say like a company building the next social network or some deep tech company. You're going to have more latitude to define what success looks like. No one business is identical to another, and nobody knows your business better than you. So it's helpful to think through what metrics you need to convince yourself that this business is working and worth the next 10 to 15 years of your life. And if you've reasoned through that effectively, there's enough investors out there, some who are product-led, some who are traction-led, some who are team-led, that you can find and win onto your side. If you like this video, it's part of a series I'm making, demystifying what it takes to raise venture capital. You can check them out on my channel or subscribe to get notified when I make new videos. Thanks so much for watching. I'll see you next time.